We need help. Dennis Gartman, the Gartman letter editor and publisher, is with us. Dennis, are you going to hold our viewers' hands and say, don't worry, this is not the start of a huge sell-off? Are you going to tell them that?
No, I'm not. I'm going to tell them, do indeed worry. This may be the start of a large sell-off. It is a large sell-off in global terms. We have not been to new highs since January. We've actually been in a global bear market since January. The fact that we broke 2,000 points last week, bounced yesterday on lighter volume, is very disconcerting. And the fact that we're giving back so many points today, another 215 as we talk, I think you have to be very careful. And I think rather than being aggressively long, you should be demonstrably less so. So, no, I'm not going to hold your hand. I'm going to tell you it is time to be very concerned.
What's the big problem, Dennis? Is it just that we've gone up so far, so fast, over such a long period of time, it's time for a pullback? Is that it?
No, I think what the real problem is the fact that the fuel that sponsored the bull market, the adjusted monetary base, which had been expanding dramatically, reached its peak in September of 2015 and has been declining since then. The Fed has quietly been allowing its balance sheet to roll off. That's the fuel that sponsored the bull market. That's the fuel that sponsored the economic rebound. And here we are. It is very normal for the economy to continue to strengthen, and it shall, but for stock prices to weaken long before the economy turns lower, because there's less fuel abundant out there, and what fuel there is has to come out of the equities market to continue to expand the supply of labor and equipment and plant.
But hold on a second, Dennis. You and I have both been around a long time, and we surely understand that the baseline for stock prices is the profits made by the company whose stock you buy. And there's nothing wrong with profitability at the moment. We're likely to go up, 20% in the current reporting season?
Yeah, well, we will likely be 20 or 25%. That's not what's important. What's important is the fuel has been taken away, and what is the propensity or what is the capability of next quarter's earnings to be even more egregiously high, likely greatly diminished from there. The market does a good job of forecasting, of anticipating, of discounting the future, and the future has been and continues to be relatively bright. But history shows that stock prices go down long before the economy turns lower. So I'm just telling people, be careful, be less long. It's been a long and protracted and wonderful bull market, and with less fuel, it's likely not to continue.
Here's something that you completely missed, Dennis, because you only buy stocks whose product you can drop on your foot. Okay, I'm talking Netflix. They reported blowout profits, added nearly 7 million new subscribers worldwide. The stock today is up nearly 6%, $20 a share. You totally missed this rally in the big techs. No. What do you got to say for yourself?
Not a question. I'm going to say it's something that I don't understand. I shall never understand big tech. It's something that's beyond my ken. I let that to the millennials. God bless them. But take a look at what Netflix has done. Yes, it's up 6%, but Stuart, after the report came out last night, it was up 15%. We're down $20 or $25 from the high. Woe betide us if Netflix were to somehow get lower upon the day. I don't think that's going to happen. But what if it does? Then you have to be very concerned. Netflix is down dramatically from the highs made in the opening minutes after the release of earnings yesterday afternoon. That's what's important right now.
Okay, Dennis, we hear you, and thanks again for joining us on a big day. For us, at least. Thank you very much indeed.